Well, it is a little bit more of a cyclical company than Microsoft. It's exposed to advertising, and I think we saw the weakness in exactly where we thought we might see weakness, which is in the YouTube part of the business. So, does it really change the story long term? No, but this was, I think, something people were bracing for and anticipating. I think it'll be very interesting to see how the stock trades tomorrow. Management obviously doesn't give a lot of commentary on the press release. We'll hear a lot more on the call. And, we're going to get a sense for how much of the bad news is priced in.
I mean, EPS and revenue growth has been slowing. How concerning is that to you?
It's concerning, but if you look at the comparisons from last year, I mean, the rebound out of COVID was extremely strong. So, of course, it's going to slow. It's mathematically almost impossible, and especially for a company of this size, not to slow. The question is, what is an appropriate multiple and valuation? And it around 20, 21 times, and take cash out if you want. It's even cheaper. You get to a point where a lot of this is priced in. From a growth perspective, it's more about hitting expectations and ability to predict and provide a good visibility to what the business trends look like over the medium term. And, a little bit of a miss in YouTube, that raises some fears that maybe that's a canary in the coal mine, that we'll see more weakness as the year progresses. And again, we don't know until we hear management's commentary on the call.
You underscore what is the biggest question, not just for this stock, but arguably the entire market. What is the appropriate multiple? I think those were your exact words. And what makes it so difficult is we just don't know what the environment is going to end up being.
That's right. I mean, we could paint a picture of inflation being runaway and the Fed hiking, 7 or 8 times or whatever the market's expecting from here. The 10-year goes to 4%, and even 20 times doesn't look like an appropriate multiple. And just as easily, we could have a bit of a slowdown, whether it's a recession or a mid-cycle slowdown. Inflation cracks, the Fed backs off, and all of a sudden these secular growers look a lot more attractive. So this is what this is the tension that the market's dealing with, is trying to predict which one of these paths we're going down. And that's at least our view.
So let's take a look at Microsoft shares. I did mention a beat across the board. One thing that stands out to me, if you look at the stock, it's not an overwhelming response, if you will. Azure, right? That's the critical point of growth for Microsoft as it tries to compete with Amazon. And you can see that the stock now in overtime is actually lower. Last quarter, Azure's growth rate was slightly under 50%, and it was again this time. What do you make of that, and is that concerning as well to you, as I said, in what is a critical area of growth for Microsoft?
Yeah, I mean, you nailed it. This is the biggest thing we look at when we look at Microsoft's earnings are Azure's growth rate and the gross margins of the company, right? These are big metrics. So Azure is something that a lot of investors focus on, and rightly so. Is 49% good enough? Like hitting number? I think hitting numbers are pretty good. And we're now getting to the point where this is about a $45 plus billion run rate business. To continue to grow, in the mid 40s is an extremely robust growth rate. I think it'll be important to see how Amazon Web Services grows as a comparison. But I find this number to be pretty good. In fact, I was a little nervous about foreign exchange maybe rippling through Microsoft's operations or results. That's happened a number of times in the past. And it doesn't look like it's been that big a hit. So I'm actually pretty happy with these numbers I'm seeing out of Microsoft.